Dividend growth investing. Meet Sarah, a 28-year-old teacher who discovered something amazing. Instead of chasing hot stocks that might crash tomorrow, she found companies that pay her more money every single year. This is dividend growth investing, and it's like having a salary that gives itself a raise. Sarah buys companies like Coca-Cola, which has increased its dividend payment for 61 straight years. Think about that. Through recessions, wars, pandemics, and market crashes, Coca-Cola kept paying shareholders more money every single year. Here's how it works. You buy a stock that pays a 3% dividend. Next year, they increase it to 3.2%. The year after, 3.5%. Your original investment keeps paying you more money without you doing anything. It's like planting a money tree that grows bigger fruit every season. The magic happens over time. Sarah's $10,000 investment, paying 3%, gives her $300 the first year. But after 20 years of 7% annual increases, that same investment is paying her over $1,100 per year. Her dividend alone is now higher than her original yield. Companies that consistently grow their dividends are usually mature, profitable businesses with predictable cash flows. They're not trying to take over the world overnight. They're just quietly making money and sharing it with shareholders year after year. Dividend aristocrats. The stock market has its own version of royalty, and they're called dividend aristocrats. These are S&P 500 companies that have increased their dividends for at least 25 consecutive years. There are only about 65 of them, and they're basically the Navy SEALs of dividend investing. To become a dividend aristocrat, a company has to survive multiple recessions, market crashes, and economic cycles while still increasing payments to shareholders. It's like being a restaurant that stayed profitable through every food trend, economic downturn, and global crisis for a quarter century. Companies like McDonald's, Walmart, and Johnson & Johnson didn't just survive the 2008 financial crisis, they increased their dividends during it. While other companies were cutting payments and laying off workers, these aristocrats were writing bigger checks to shareholders. The dividend aristocrats have historically outperformed the broader market with less volatility. It's like getting better returns with a smoother ride. During market crashes, these stocks often fall less because investors know they'll keep getting paid. But here's the catch. Not all aristocrats stay aristocrats forever. Some companies eventually break their streak when business gets tough. That's why you need to watch the fundamentals, not just the track record. High yield strategy. Some investors don't want to wait 20 years for their dividends to grow. They want big payments right now. Enter the high yield strategy, where investors chase stocks paying 6%, 8%, or even 10% dividends. Meet Mike, a retiree who needs $4,000 per month to live. Instead of slowly building a dividend growth portfolio, he buys high-yield stocks and REITs that pay massive dividends immediately. His $500,000 portfolio, yielding 8%, gives him $40,000 per year, exactly what he needs. High-yield stocks often come from sectors like utilities, telecommunications, and real estate investment trusts. These companies generate steady cash flows and pay out most of their profits as dividends. Electric utilities are perfect examples. People always need electricity, so the cash flow is predictable. But high yield often means high risk. Companies paying 10% dividends are usually doing it because their stock price has crashed. The market is basically saying, this dividend probably won't last. It's like finding a luxury car for half price. There's probably something wrong with it. The key is distinguishing between sustainable high yields and dividend traps. A utility paying 6% because it has stable cash flows is different from a struggling retailer paying 8% because its stock price collapsed. Dividend reinvestment. Here's where dividend investing gets really powerful. Instead of spending your dividend payments, you use them to buy more shares of the same stock. This creates a compounding effect that Albert Einstein supposedly called the eighth wonder of the world. Let's say you own 100 shares of a stock trading at $50, paying a 4% dividend. You get $200 in dividends, which buys you 4 more shares. Now you own 104 shares. Next quarter, those 104 shares generate slightly more dividends, which buy even more shares. This snowball effect accelerates over time. After 10 years of reinvesting, you might own 150 shares. After 20 years, maybe 250 shares. Your dividend payments keep growing, not just because the company increases its dividend, but because you own more shares generating those dividends. Many companies offer dividend reinvestment plans that automatically reinvest your dividends with no fees. Some even offer discounts, letting you buy shares at 3 to 5% below market price. It's like getting a bulk discount for being a loyal customer. The psychological benefit is huge too. Instead of seeing dividends as spending money, you're forced to reinvest them. It removes the temptation to blow your dividend payments on unnecessary purchases. International dividends. American companies aren't the only ones paying dividends. Some of the world's best dividend payers are overseas, and they often pay more than American companies. European companies like Nestlé, Unilever, and Royal Dutch Shell have been paying dividends for over 100 years. Many European and Asian companies have different business cultures that prioritize steady dividend payments over aggressive growth. Foreign dividends often come with higher yields because international markets are less efficient than the US market. You can find quality companies paying 5 to 7% dividends that would only pay 2 to 3% if they were American. But international dividends come with extra complications. Currency fluctuations can boost or hurt your returns. A 5% dividend becomes a 3% dividend if the foreign currency drops 2% against the dollar. There are also tax implications. Foreign governments often withhold taxes on dividend payments, though you can usually claim credits on your US tax return. Some countries have tax treaties that reduce withholding rates. The easiest way to get international dividend exposure is through ETFs that hold foreign dividend stocks. You get diversification across countries and currencies without having to research individual foreign companies. Value versus growth dividends. Not all dividend stocks are created equal. Some pay dividends because they're mature companies with limited growth opportunities. Others pay dividends while still growing aggressively. Understanding this difference is crucial. Value dividend stocks are typically older, established companies in boring industries. Think utilities, consumer staples, and telecommunications. They pay steady dividends because they generate more cash than they can profitably reinvest in their business. Growth dividend stocks are companies that are still expanding but choose to share some profits with shareholders. Think Microsoft, Apple, or Visa. These companies could reinvest all their profits for growth, but they pay dividends as a sign of financial strength. Value dividend stocks often have higher current yields but slower dividend growth. Growth dividend stocks have lower current yields but faster dividend growth. It's the difference between getting a bigger paycheck now versus getting bigger raises later. The best dividend portfolios combine both types. Value stocks provide current income and stability. Growth stocks provide future income growth and capital appreciation potential. Sector rotation strategy. Smart dividend investors don't just buy and hold forever. They rotate between different sectors based on economic cycles and market conditions. This is called sector rotation, and it can significantly boost your dividend returns. During economic expansions, cyclical sectors like financials and industrials often increase their dividends aggressively. Banks make more money when interest rates rise, so their dividends grow faster. During recessions, defensive sectors like utilities and consumer staples maintain their dividends while others cut theirs. People still need electricity and groceries even when the economy tanks. Interest rate cycles also affect different dividend sectors differently. When rates rise, utility stocks often fall because their high dividends become less attractive compared to bonds. When rates fall, utilities often outperform. The key is understanding which sectors benefit from different economic conditions and rotating your dividend portfolio accordingly. It's like changing your wardrobe with the seasons. You want the right dividend stocks for the right economic weather. Defensive dividend portfolio. The ultimate goal of dividend investing is creating a portfolio that pays you no matter what happens to the economy. This is called a defensive dividend portfolio, and it's designed to survive any financial storm. A defensive portfolio focuses on companies that provide essential services people can't live without. Utilities, healthcare, consumer staples, and waste management companies fall into this category. People need electricity, medicine, food, and garbage collection, regardless of economic conditions. Geographic diversification is also crucial. Don't just own American dividend stocks. Spread your investments across different countries and currencies. If the US economy struggles, your international dividends can pick up the slack. Sector diversification prevents any single industry from destroying your income. Don't put all your dividend eggs in one basket, even if that basket has historically been very reliable. The goal is creating multiple streams of dividend income that are unlikely to all disappear at the same time. It's like having several part-time jobs instead of one full-time job. If you lose one income source, you still have others. Building a defensive dividend portfolio takes time and patience. You're not trying to get rich quick. You're trying to get rich slowly and safely. But once you build it, you'll have a money machine that pays you every quarter for the rest of your life. Remember, dividend investing isn't about finding the highest yield or the fastest growth. It's about building a portfolio of quality companies that will pay you consistently for decades. Start with one strategy. Master it, then gradually incorporate others as you learn and grow. The best time to start dividend investing was 20 years ago. The second best time is right now.